All right, everybody, here we go. Today is Thursday, March 21st. Like I said yesterday, let's go back to yesterday. Let's go back to the Fed's announcement, which surprised the markets because now 0 rate hikes expected for this year and only 1 rate hike expected for next year in 2020. Now, as I said, that could change because the Fed is still following conditions, basic economic conditions, if they see inflation picking up. And let me just mention that in their statement, they pointed to low oil prices as the reason for declining inflation. But we have seen recently oil prices back up over $60, so there's been a big recovery in oil prices. So the inflation numbers could change in the next few months, and that might cause the Fed to, take a closer look and reassess the situation. But let's just take them at their word right now. No rate increases this year, only 1 next year, and the end of balance sheet roll-off, which I predicted, by the way, if you go back to January, the January 30th Fed meeting, right after that, and I spoke about this on numerous videos that I made at the time, where I thought it was very clear at that time that Powell was saying we're going to end balance sheet roll-off. Everybody was saying, no, that's not what he said. That's not what he said. I said, the guy is saying it. Maybe not in direct language, but that's what he was alluding to. And of course, I was right about that. They are ending it. Now, I've said before, Powell got spooked by the stock market correction in December. He ended the rate hikes because he was afraid of or listened to the cries and the pleas coming out of Wall Street, and also the bashing he was being handed by President Trump. So he acquiesced to that, and he's ending balance sheet roll-off. Now, the interesting thing, and what I mentioned yesterday, and this is pure MMT, I said, these developments, the end of rate hikes and the end of balance sheet roll-off, is bullish for the dollar. Bullish for the dollar. And I said yesterday the zombies rushed in there and they sold dollars, and I said this is all going to be reversed. And of course you're seeing that today. These things are not bearish for the dollar, they are bullish for the dollar. The mistake I made back in January, I should have exited my dollar shorts at that time because I thought the Fed was going to continue with its rate hikes, but it didn't. Now I'm in a position, I have a small profit, I'm going to manage this position. I am not getting out right now. I am going to manage the position for as long as it takes and ultimately get out with a much bigger profit. But January 30th, when the Fed said that was it, on the rate hikes, and remember, people sold the dollar that day too, and it is higher now. These developments, the end of rate hikes, the end of rate hikes, and the end of balance sheet roll-off, what all the zombies in the world think is bearish for the dollar, this is bullish for the dollar. Okay? And I said that yesterday. So that's where we are at this point. There are still factors which will, I would say, work against a strong rally in the dollar. That is the fiscal situation, large fiscal deficits, record levels of government spending. That is literally the printing money. They're printing money! They're printing money! That's literally the printing money. In addition, the trade situation, and I'm not really talking about China here, the trade deficit, okay, where there's a net export of dollars into the world, okay, that puts downward pressure long term, but that's very, very long term. That's like turning a super tanker. I mean, it just doesn't happen on a dime, but it is a constant background and persistent pressure on the exchange rate when you're running big current account deficits. But it's not something that's going to show up on a daily basis. It's not going to show up on a weekly or a monthly. Sometimes it doesn't even show up on a yearly basis. But over time, it does put pressure. So that's where we are right now. It also, the Fed's actions limit the upside in gold. I will say that. Although gold has its own fundamentals, which really boil down to very little new mine supply and rising demand. Okay, so you don't have enough new supply to meet demand, which means that over time the price will go higher, but this is going to be a very slow climb for gold, especially if the dollar starts to come back now towards the highs. If you use the dollar index as a proxy or a general barometer of where the dollar is. So that's where we are. I would make a bet right here that you have to sell treasuries. Now, back when the 10-year yield, and I think I made a video about this, but I did send it out to all my subscribers, when the 10-year yield hit 2.75% a few weeks ago, I said you have to buy bonds, or if you are in a short treasury position, you have to hedge that. That was the top of the yield. Now they're down to 250, the 10-year. You have to now sell treasuries. Sell treasuries, because they're not going much lower than 2.5. That's where the Fed funds rate is. So, you know, they might dip marginally below there, but this is a sell treasury level. So that's where we are. It's just a quick update I wanted to give everybody. Again, all this stuff comes in my report, MMT Trader. It is the only applied approach to MMT. You can get a 30-day free trial. Go to my website at pitbulleconomics.com and sign up. Or you could sign up for Zombie Trading, which is my daily Forex signal service. So yeah, that's it. See everybody later. Bye-bye.